Welcome to this explainer. Today, we're jumping straight into the spectacular rise and the equally spectacular fall of the Medici Bank. We're going to trace how a devastating 14th century financial collapse basically birthed the modern corporate holding structure. It is a wild ride from the catastrophic banking failures of the 1340s right to the invention of a decentralized financial web that literally changed global commerce forever.
So let's start with a high-stakes question. How do you survive a king who just flat out refuses to pay his debts? We're starting here because lending to medieval monarchs was, without a doubt, the ultimate toxic asset in early global finance. Think about it. Back in the Middle Ages, liquid capital was incredibly scarce, and central governments, well, they were wildly unstable. Kings essentially treated national debts as personal IOUs, and because of that, they had this terrible habit of just defaulting on whatever their predecessors owed. So if you're a banker back then, how on earth do you even begin to price that level of risk?
Well, you charge absolutely astronomical interest rates. To compensate for the massive looming risk of a total default, rulers like Frederick the Fair of Austria were hit with staggering rates. We're talking up to 80%. Emperor Frederick II usually paid somewhere between 30 and 40%, and the Angevin King of Naples paid about 30% back in 1319. But as we're about to see, even those massive premiums couldn't save a bank if its foundation was fundamentally flawed.
And that brings us to the disastrous 1340s. This is when the great Florentine super companies, specifically massive players like the Bardi and the Peruzzi, faced absolute total ruin. Why? Because England's King Edward III just decided not to repay the massive sums he owed them on time. But here's the kicker. It wasn't just the royal default that killed them. It was their actual corporate structure. These super companies were entirely monolithic. They were highly centralized under one single partnership in Florence that literally owned everything, and all their branch employees were just paid a standard salary. So when the king defaulted, that single giant behemoth just collapsed under its own weight, sending a massive banking crisis rippling through all of Florence.
And that total disaster perfectly highlights the structural pivot that came next. The old, centralized model of the early 14th century meant that a toxic exposure in just one branch completely poisoned the entire company. So what was the revolutionary fix? A decentralized web, a structure explicitly designed to survive those nasty sovereign defaults. And this was the brainchild of the Medici family, who clearly learned some hard lessons from the ashes of the Bardi and Peruzzi.
Which leads us to part one, the Medici solution, and how they went about decentralizing risk.
To protect his money from the kind of toxic royal debt that wiped out the guys before him, Giovanni di Bicci de Medici set up his bank in 1397 by essentially inventing the modern holding company. Instead of structuring the bank as one giant, vulnerable entity, he built a network of separate, legally distinct partnerships. The parent bank back in Florence acted as the central hub, and it claimed ownership over the stock of these independent branches scattered across Europe's major commercial centers. By legally isolating each branch, the Medici guaranteed that if, say, one branch manager made a horrific lending mistake, the legal liabilities were completely contained within that specific partnership. The core capital back in Florence? Totally insulating. And the capitalization strategy here is just brilliant. The central bank in Florence held exactly 50%, or sometimes just a tiny bit more, of the equity to maintain control. The other half, that was provided by the branch managers themselves. These managers weren't just salaried employees like in the old Peruzzi days. No, they were junior partners. They had serious skin in the game. They shared directly in the profits, but crucially, they also took the hit on any losses. This completely decentralized setup beautifully aligned the manager's personal financial survival right alongside the health of the entire bank. But a clever structure alone wasn't going to cut it. They needed ironclad operational rules. To protect this new hub-and-spoke system, Giovanni instituted what was basically a golden rule: an absolute, strict ban on lending to secular authorities. Princes and kings were explicitly red-flagged as terrible investments. In fact, under no circumstances was a branch manager allowed to sell foreign exchange on credit to royalty or high-ranking officials without risking the immediate, on-the-spot dissolution of their partnership by the Florence headquarters. And you know what? By strictly enforcing this rule, the Medici Bank enjoyed an absolute golden age. They pivoted hard into commercial transactions, foreign exchange, and most importantly, papal banking. The Rome branch acted as the fiscal agent for the church's treasury, which was unbelievably lucrative. Riding on that incredibly steady revenue, they rapidly expanded this decentralized network out to Venice, Geneva, Bruges, and London. They quickly became the largest, most respected bank in Europe, effectively transforming the Medici family into the unofficial heads of state of the Florentine Republic. When you look at the timeline, it actually reads like a classic Greek tragedy. From the massive collapse in the 1340s to the brilliant restructuring in 1397, you have decades of unbelievable success. But watch what happens right after the death of Cosimo de' Medici in 1464. This massive empire, which was entirely built on strict rules and decentralized discipline, slowly begins to rot from the inside out. Ultimately, it falls victim to the exact same monster that destroyed the super companies generations before. Which brings us to part 2, the tragic irony and the fatal mistake of forgetting that all-important golden rule. Decades later, as the Medici family's political ambitions swelled under leaders like Lorenzo the Magnificent, the new managers began breaking the very rules that kept the bank alive in the first place. The first major cracks showed up in the London and Bruges branches. You see, the managers there found themselves in a really tight political spot. To lock down crucial export licenses for English wool, which Florence desperately needed for its massive textile industry, the London branch started loaning enormous sums to the English king, Edward IV. Meanwhile, over in Bruges, the branch manager decided to cozy up to the local court by making massive, totally excessive loans to Charles the Bold of Burgundy. The ghost of the Bardi and Peruzzi was officially back. Without rigorous, strict central oversight, that decentralized system suddenly morphed into a huge liability. Branch managers were out there chasing political clout instead of financial stability. Over in England, they didn't just loan money to Edward IV, they disastrously backed Lancastrian rebels during the Wars of the Roses. Rebels who, by the way, were completely defeated and obviously never repaid a single dime. And back home in Florence, the general manager, Francesco Sassetti, just flat out failed to enforce the strict accounting audits that used to keep these branch managers in line. Giovanni's golden rule was completely thrown out the window. The sheer hubris of these branch managers is perfectly captured in a famously sarcastic memo from Lorenzo the Magnificent. He was writing about Tommaso Portinari, the guy running the Bruges branch. Portinari was, to put it mildly, a terrible manager. He was running side hustles, buying galleys that immediately got lost to pirates, and making wildly unauthorized loans to Charles the Bold. When the books finally got audited, Lorenzo realized with bitter irony that Portinari's unchecked ambition had completely doomed the branch by drowning it in toxic sovereign debt. The financial carnage that followed was just staggering. When the Bruges and London branches were finally forced into liquidation around 1478, the Medici Bank had to eat losses upwards of 70,000 gold florins. Just to put that into perspective, it was a massive fortune. And historically speaking, that 70,000 figure is actually the optimistic estimate, assuming their recorded assets were even worth anything at all. This wipeout severely crippled the entire network, draining its liquidity so badly that Lorenzo eventually had to raid Florence's state treasuries just to keep the lights on. By 1494, following a French invasion, the entirely insolvent bank was completely liquidated. It was the end of an era. The Medici designed a truly brilliant structural firewall to survive the exact crisis that eventually killed them, all because they simply stopped enforcing their own rules. So we'll leave you with this final thought to chew on. When you look at our modern corporate world today, with its incredibly complex holding companies and massive exposures to sovereign debt, have today's too-big-to-fail financial institutions actually remembered the 14th century lesson that the Medici ultimately forgot? Thank you so much for joining this explainer. We'll see you next time.